Every single time you buy a stock, somebody else is selling it. It's a simple fact. But have you ever really stopped to think about it? Who is on the other side of that trade? Today, we're going to dig into a really fascinating report from Morgan Stanley that tackles that exact question.
I mean, think about it. You click buy on your screen, and somewhere out there, someone is clicking sell. Who are they? Are they some Wall Street genius? Do they know something you don't? This is probably the most fundamental question in all of investing. And as we're about to see, the answer has changed more in the last 10 years than maybe in the 50 years before that.
All right, so to really understand what's happening in the market today, we have to go back to the beginning. We got to talk about the classic textbook theory of how markets are, well, how they're supposed to work. It's a really powerful idea, but you'll see pretty quickly, it's mostly a myth.
Okay, so here's the big one. It's called the efficient market hypothesis, or EMH for short. It was championed by Nobel laureate Eugene Fama, and the idea is basically this. You can't consistently beat the market. Why? Because any and all information, every earnings report, every news headline, every rumor, is already baked into a stock's price, instantly.
Now, this slide has a great analogy. Think of a perfectly efficient market like a perfect machine. You know, one of those perpetual motion machines that turns every single bit of energy into useful work. But we all know from basic physics that's impossible, right? You always lose some energy to heat or friction. Well, it's the exact same thing with markets. Information isn't free. It costs time and money to get it, so some of it is always going to get lost along the way.
So, if a perfect market is basically a physical impossibility, what does that tell us? Well, it means there has to be a flaw in the whole theory, a crack in the code that allows for something, well, other than perfect efficiency.
And this quote from Lasse Peterson just nails it. It perfectly captures the real world. Markets aren't perfectly efficient, but they're not totally chaotic either. They live in this really interesting gray area that he calls efficiently inefficient.
And here's the intellectual firepower behind that idea. It's called the Grossman-Stiglitz paradox, and it's just this beautiful, elegant piece of logic. It points out a massive catch-22. I mean, think of all those analysts and portfolio managers, right? They're digging through financial statements, interviewing CEOs. Why are they doing all that work? They're trying to find an edge, to make a profit.
So let's just walk through the logic. Step 1. Digging up good information costs real money and takes a lot of effort. Step 2. To make that cost worthwhile, you need the chance of a reward, the possibility of beating the market. But, and here's the kicker, step 3. In a perfectly efficient market, there are no rewards to be had. So, if there's no reward, nobody does the research, and the market stops being efficient. It's like a snake eating its own tail. It just can't work.
Okay, so we've established that the market is imperfect, but the real question is, just how imperfect is it? Well, when you look at the actual data, you realize the game of investing isn't just a little imperfect, it is incredibly, wildly lopsided.
And this leads to a massive question. If most stocks are actually kind of duds, and the market is inefficient, where does all the long-term wealth that we hear about actually come from? The answer is pretty mind-blowing.
So let's start with this number. Let this one sink in. According to some incredible research by Hendrik Bessenbender, a whopping 59% of all U.S. stocks since 1926 have done worse than just holding ultra-safe treasury bills. Think about that for a second. The majority of companies ever listed on the stock market have basically destroyed wealth compared to just holding cash.
But it gets even more extreme. Are you ready for this? All of the net wealth created in the entire history of the U.S. stock market was generated by just 2% of companies. A teeny tiny fraction of massive winners were responsible for pretty much all of the gains.
And this isn't just about how stocks performed. A totally different study looked at the companies themselves, and it found that 71% of companies, over their entire lifetime, never even generated enough profit to justify the price people paid for their stock in the first place. The takeaway is just crystal clear. Winning in the stock market is a needle in a haystack game.
So, this brings us right back to our main question. Given this totally lopsided reality, understanding who you're trading against, who is on the other side of your bet, has never been more critical. And that answer has gone through a seismic shift.
You know, for decades, the basic rules of supply and demand, of buying and selling stocks, haven't changed all that much. But the players, oh man, the players have been completely transformed. Who is buying and who is selling today looks nothing like it did 20 or 30 years ago. And that changes absolutely everything. Okay, just look at this chart. This right here tells the whole story. Look at those two lines crossing. Since 2006, we've seen a massive multi-trillion-dollar migration. Over $3.2 trillion has flowed out of active funds, and $3.2 trillion has poured into passive funds. This is probably the single biggest structural change in the history of modern finance.
So let's be super clear about who these two players are. On one team, you've got active investors. These are the classic stock pickers, right? The detectives trying to find those hidden gems. They're doing the research that, as we just learned, actually helps make the market work. And on the other team, you have passive investors. They're not trying to be detectives at all. They're just buying the entire haystack, every single stock in an index like the S&P 500 to match whatever the market does. In a way, they're free-riding on all the hard work the active players are doing. So we have this enormous shift in who is actually playing the game. What does this new world, dominated by these passive, rules-based investors, actually mean for the rest of us? What are the new rules?
Okay, here's where it all comes together. This is the crucial point. When a company gets added to the S&P 500 index, every single S&P 500 fund out there has to buy its stock. They don't have a choice. It doesn't matter if it's overvalued or undervalued. They're just following a rule. This creates these huge waves of buying and selling that have nothing to do with how the company is actually doing. These technical moves can create some really weird price distortions, whole new kinds of inefficiencies. For an active investor, knowing that the person selling to you might be a giant index fund that must sell, not one that wants to sell, well, that changes the entire game.
So the market isn't some perfect, efficient machine. It's a lopsided game where a tiny handful of big winners drives all the returns. And now, the very players in that game have fundamentally changed, creating brand new wrinkles and new opportunities. So the real question this leaves us with is this. Now that you know who might be on the other side, how does that change your play?